So I get asked a lot about outsourcing your underwriting and, oh, do you have a recommendation for a service that can underwrite our deals for us as a third party? First of all, I don't have a recommendation. And second of all, I really discourage actually outsourcing your underwriting. Outsourcing is a very core and key process to your acquisitions process, and you need someone, doesn't have to be you necessarily, but you need someone that's very senior at your company that really owns and understands the underwriting process and can really provide the final sign-off on a deal. If you are relying upon a third party, that's their model, that's their process, that's their assumptions, and it really creates duplicative work, in my opinion, where then you have to go over their assumptions and so forth. Keep that competency in-house so you can scale it eventually where you have analysts on your team that can do the initial underwriting, and then that's vetted by more senior people, and that way you can tackle more deals with a larger team. But keeping that underwriting competency in-house will really serve you well. This concept can also be applied whether you're a sponsor or if you're a co-GP, capital raiser, or a fund of funds manager. It's different though. So if you're a sponsor, you're underwriting often the same type of deal over and over again because you have a focused strategy, hopefully. In my opinion, sponsors really benefit from focus. But if you're a capital raiser or a fund of funds manager, then actually one of your advantages is diversification. You can offer your investors a more diversified opportunity set, but what that means is you have to now take on the burden of being an expert and have the ability to underwrite more different types of asset classes, different strategies, and that is difficult, and that may cause you to want to outsource again, but again, it's not the wisest thing. The competency needs to be in-house. The benefit of the fund of funds model, though, is you're underwriting other sponsors' deals, so you're not underwriting unvetted deals. They're already packaged up nicely. There's already the sponsors underwriting and their assumptions. You just need to take the next step to take their model, take their assumptions and their business plan and plug it into your in-house model, so that way you're keeping things consistent and you're able to really see the deal for what it truly looks like through your own relative lens. At the end of the day, we don't underwrite absolutely, we underwrite on a relative basis. Every week, our company looks at 10 to 20 deals, and we're looking to acquire about 2 deals per quarter, right? So of the 100 deals, 200 deals per quarter that we're looking to do 1 to 2, right? So that's about a 1% hit ratio, and that's pretty classic, straightforward for real estate. And so at the end of the day, we're doing the best 1% of the deals, not necessarily any deal that fits a certain bar. So that's one of the keys why you need to keep it consistent through your own model, because everyone's model is going to spit out outputs that are slightly different, right? You might put in the exact same numbers, but my model might kick out 15% IRR and your model might kick out 17% IRR, even though the numbers and assumptions are identical. It's just the way the model is constructed and the calculations on the back end.